If trading is something that you want to do for life, if you want to do it seriously, you have to get educated, and always OTA.
When I sat in that audience and began to see kind of like my life in front of me going, wow, these are the tools.
You know, you want to be good at something, find somebody that's good at it and do what they do. I've learned that all my life, and these people are really good at it. Not only are they good at what they do, they're good at teaching. So to try to attempt this on your own, as Dr. Phil would say, good luck, let me know how that works out for you.
There are lots of different ways to be a successful investor. I find this one intuitively supportive, and I enjoy doing it. And again, the tools and the resources they provide really make this very helpful.
It was very satisfying and very exciting. I'm very thrilled that I made the investment with OTA.
It's a community, and that aspect of community was something that I hadn't seen anywhere in a financial education setup.
Depending on how much time and energy you want to put into trading, OTA has a strategy for every person.
Good morning, folks. How you guys doing today? Good? Just okay? It's a beautiful day. I mean, I think the weather's been no rain in the forecast, but it's a nice, beautiful Saturday. So I'm glad you guys joined us today. Thank you for coming. My name is Hassan. I'm going to be your presenter for the next about a couple hours, 1.5, 2 hours. We'll take a break at the middle point, quick bio break, 5-10 minutes, stretch your legs and all that. So your safety is our number one concern today. Please make sure to keep all the face masks on at all times and 6 feet apart. We have some hand sanitizer in the back. You guys are welcome to kind of check out the area during a break. Keep your cell phones on vibrate. And if you need to take the call, you could step outside and do that, okay? Awesome, let's get started. So I got a lot to cover today, so I'm just gonna jump right into it. We are in the financial world, so disclosures and disclaimers are relevant. Please realize that none of the education here today is to help you become a licensed broker or a financial advisor. This education is more about you and taking back control of your own personal finances. Throughout the presentation, I don't make any recommendations to buy or sell securities. There's risk in the markets. We'll talk a lot about risk today. But we don't promise that you're going to make millions of dollars or that you won't lose money in the market, okay? And then I like to show trade examples throughout the session. Today's Saturday, so there's no market that's open. So most of the time I like to use real-time data whenever I possibly can. And then everything here is copyrighted, so please don't take pictures or videos. You're welcome to take notes on your notepad. Usually what I put on the board here is usually important, so you're welcome to copy that over here. And then, like I said, there's risk in the markets. But why do we take risk? We take risk for the probability of more reward, right? We don't want to take a crazy amount of risk. We want to take what we call good risk, calculated risk. Okay, and I'm going to show you guys how our platform Click brings the risk together, okay? And options get their own special disclaimer. There's leverage in the options market. So before you start trading those, you're going to want to contact your broker, okay? All right, so kind of the formalities out of the way. Let me talk a little bit about OTA and where we started and how this whole academy began. So we've been in the financial world for about 23 years now, coming to 2021. And it all started back in 1997. So back in 1997, we started as a retail trading floor, okay? So back then there was, the internet just kind of came out about 2 years and people could now finally trade online. But they couldn't do it at home because you needed high-speed internet, and that just wasn't readily available back then. So they would go into what they call these retail trading floors. And this is actually a picture of our retail trading floor back in 1997. You'll notice all the CVT monitors over here. But what we found out was people really didn't know what they were doing. They were losing a lot of money. So we created the education arm to the business, and we've been doing that ever since. So since our first center, we've grown to over 40 across the world. Most of our centers are here in the United States. We have some in Canada, we have in United Kingdom, Middle East, there's 6 in India, and then 2 in South Asia. So that's kind of a little bit of a history lesson with OTA. And over 100 classrooms. We have 60 instructors in our network. So these are all people that have some type of floor trading experience, and they teach in the network now. So a lot of perspective from different people who trade been trading for a long time. All right, so what we want to cover today are 3 main things. So I want to talk about some of the common mistakes that individuals make when considering their income and wealth goals. And that's really important. I'm going to kind of break down today the difference between trading and investing and how that kind of puts you on a path to what you're trying to accomplish. Okay. Now, a lot of people, when I talk to them, they say like, well, Hassan, I see a lot of videos, I watch a lot of YouTube, read books, but I just don't know where to start. I really want to do this, but I need some direction on where I can begin. So we have, here at the Academy, we have a core strategy, which is literally our core strategy. It's designed to help you think, act, and execute like the professionals do, okay? And I'm gonna talk a lot about core today. It's basically the foundation of everything that we do here at the Academy. And then give you the opportunity to work with us to create a customized, individualized personal planner. So I'm going to throw out a lot of ideas and concepts, and you're going to have some aha moments, like, wow, didn't realize that. I like to keep a good pace, and I run a really interactive class. But we like to slow things down for some of those that kind of really want to get their fingernails underneath the concepts that I share with you today. So I'm going to invite you guys back to a 3-day class that I have coming up, and we're going to talk about some of that today too, okay? So let's start with defining some terms. So, income and wealth. So income is basically the cash flow of either a single trade or multiple trades after commissions and losses, okay? So, like people are like, well, I want to learn how to do this to try to generate some type of income, some type of cash flow. I like my job, but I kind of want to do something on the side. Like for me, so a little bit about me. I started with Online Trading Academy about 2 years ago, and like most people, I was kind of fairly new to the market. I did a little bit of trading before then, mostly stocks, but now I trade futures. I've been trading futures for the last 2 years, and I like futures because mostly the leverage that's involved. So when people ask me like, what do you like trading? Well, what should I trade? I'm usually partial to futures because that's just what I do. So we're going to talk about the different markets today as well that you can trade in. And on the other side, we have the wealth. So wealth is basically increasing the value of your total portfolio of assets over time. So you're in these positions for longer periods of time. And because of that, it's subject to market fluctuations, okay? We'll talk a little bit about the volatility that is happening pretty much now since the beginning of COVID, okay? And the most important thing for me is like trying to understand, when you guys spend, time out of your day to come join here. So really, what's the motivational factor? That's important. I'll tell you why. Because trading and investing is highly emotional. Fear and greed are 2 of the most powerful feelings, emotions that we humans have, especially when we're talking about trading with real money, right? So motivation is important because, everyone's going to have to face some realities when you trade. One of those realities is losing, okay? People have a natural fear of taking a loss in the market, okay? That's why a lot of people they buy and hold, right? Buying and holding is not really a strategy. But people do that because they're not okay with taking a loss. We're going to talk about that a lot today. Okay, we're going to talk about how institutions trade, and even institutions take losses. So we got to be okay with taking losses, but we want to make those small. Okay. So the wealth side. So those are just some of the reasons. Some people say, well, you know, I'm good with cash flow, but I'm a little behind with my retirement plan, right? So they want to use short-term trading to contribute to long-term wealth growth, right? So they want to use that cash flow to feed their wealth bucket, right? And then some of the reasons I hear for wealth, like, well, why do I want to focus on that? Well, I mean, the reality is we all have to retire at some point. We can't work forever. So we need to develop a plan that's going to help us when we retire, right? So having, you know, helping families, sleeping well at night, cover medical expenses. A lot of people don't realize that in retirement, your medical costs go up a lot, okay? So those are just some of the reasons that, you know, when I talk to people, they tell me, right? So you guys really want to think about the why, right? The why is really important. Around here, we call it the YQ. Okay, but that's your why. All right, so let's break down these two here. Okay, so we have income. And we have wealth. Okay, like we mentioned, income is cash flow. Okay, now because we're focused on the cash flow side of the business, we're looking at shorter term positions. Okay, so what do I mean by shorter term? Well, you could be in positions anywhere from hours to days. Okay, this is like the quote unquote day trader. Wealth is increasing value. Okay, and we're going to be in longer term. Okay, what do I mean by longer term? Well, you could be in positions anywhere from months to years, sometimes even decades. Okay, this is the investor. Okay, so like I said, I like to run an interactive class. Just kind of what I covered here. What are some of your guys' goals? Income side or wealth side? There you go. But what's your immediate need? Is it something that you need to focus here first to get to there? Or is it that you're okay here, but you want to focus over here? If you could pick one just to start, right?
Well, yeah, you're right. Yeah, I think so. In my case will be the left side.
The income side.
Yeah.
Income side? Okay, good. So we're starting to now align ourselves with the style, because this does become your style. And at the Academy, we use multiple time frame analysis. So I'll talk a little bit about that. But we're analyzing 3 charts for one trade, okay? And the charts that you analyze are determined by your style of trading, okay? So that's why this is really important, just to kind of start to focus in on where do I begin this journey, right? Okay? Awesome. All right, let's talk about how do the markets really work, right? So there's 2 groups of people that trade in the markets. For every buyer, there has to be a seller, okay? If I'm trading stocks, futures, forex, options, I need to know who's buying and who's selling. If I bought a contract, someone's selling me that contract, okay? So there's buyers and sellers in the market. And within the buyers and sellers, there's 2 groups of buyers and sellers. Now, before I tell you who the 2 groups are, like I said, I like to have a little bit of fun. Because most people tell me, well, Hassan, I think you're talking about the bulls and the bears, right? Isn't that who you're talking about? The bulls and bears? It's not the 2 groups. But does anyone know why we call them the bulls and the bears? Want to take a guess? Not sure? That the directional, yeah, the direction of the market. We call them the bulls and the bears because of the animal's attack style. So bulls do what? They put their horns down and attack up, and then bears paws up and attack down, right? So in a bullish, if I'm bullish or I'm in a bullish position, I'm expecting price to go up, right? And if I'm bearish, I'm expecting price to go down. Now, it's not the two groups because I could actually be both bullish and bearish at the same time. So I could be bullish on stocks like Netflix, Alcoa, Teladocs, because that's just what's happening in the world, right? People can't travel. So I might be bearish on like cruise line stocks, American Airlines, something like that, right? Because like I said, it's what's happening in the world today. People are home and they're watching a lot of Netflix, right? They're online a lot. So Amazon, all these stocks that are rallying, that you see this huge surge in the market, right, the last few months, is because of what's happening, right? So I could be both bullish and bearish at the same time, but the two groups that I'm referring to are the retail traders and investors, and that's us. That's me, you, your friends, your family. Everyone you know, it's pretty much a retail trader investor. And with retail trading and investing, we typically struggle. To be consistent, we oftentimes lose. And Dalbar did a study, they did a 30-year study, and what they found out was that the average equity investor earned about half of what the market was providing. So you could see down here, S&P 500, which is an index, it did about 10% rate of return in the last 30 years. So that's the annualized average rate of return. Some years it's up, some years it's down. But net after the last 30 years, or in the last 30 years, S&P was 10% rate of return. But the average investor earned about half of that, about 5%, right? So for me, it's like, why? Like, what's the reason? It's because a lot of times, most retail traders and investors are buying typically at the top of the market, right? They don't understand how they can get into positions and buy stocks for a discount, right? I mean, wouldn't you guys like to know how to buy stocks at a discount, right? Because right now people are buying them at the top of the market, right? So we do that for everything else. We do it for shopping, clothes, cars, TVs. We wait for those Black Friday deals, right? So why don't we do the same thing for our investments, right? So we'll talk a little bit about the difference in the type of orders you can send to the market and how you can set a limit to where you want to buy a certain asset, stock, or contract. And on the other side, you have the institutions and banks. Now they're more consistent. They're typically more profitable. In fact, I pulled a graph on Goldman Sachs, which I'll show you guys in a few moments, on how consistent, how profitable the institutions really are, okay? So you gotta kind of look at it like a competition, right? Any sporting event. You have, let's say you have on one side, one team is the amateurs, and on the other team is the pros, right? So which side do you want to be on, right? Most people are like, I want to be on the pro side, right? I want to learn how to do this the right way. So we can't really join these banks, institutions. They're big. They have a lot of money, and they have people analysts that work for them that analyze where to buy and where to sell. So you can't beat them. You can't join them. So what are you left with? Well, at the Academy, we try to teach you how to follow in the footprints, okay? So where institutions buy, we're going to buy. Where institutions sell, we're going to sell. Institutional trading, they leave behind footprints, behaviors on a chart. We're going to talk a lot about those patterns and behaviors today, okay? But who are these institutions and banks? They're people we do business with every day. Wells Fargo, Chase, Citibank, Bank of America, even insurance companies invest in the markets, right? When we pay our insurance fees. The claims that don't happen, what do you think happens to that money? Most of the times those insurance companies are investing it into the market. And then you have the major investment organizations, right? Morgan Stanley, Goldman Sachs, Berkshire Hathaway, which is owned by Warren Buffett. So these are large investment organizations. Oftentimes they're referred to as the market makers. They're the ones that drive price up, bring price down. Okay, market timing depends heavily on where to buy and where to sell. Because if I'm going to buy at a low price, I have to be able to know that price will turn once I get into that trade. That's market timing. It's anticipating a pullback in the market. So that happens because of supply and demand. So that's a very important concept. So when markets are going up and I'm bullish, I want to be in demand. I'm buying in a demand level. Okay? When markets are going down, I want to sell in supply. Okay? So the law of supply and demand is as good as gravity. It exists, it's driven by people buying and selling. If there's more willing buyers in the market, that means there's more people want to buy. That's demand, right? There's no way for price to go down if I have more people willing to buy something, right? On the other side, if I have more willing sellers than I do buyers, price has to come down. There's no other way for it to go. There's too much supply. It's typically demand is wholesale. So we're going to talk about these terms a lot today. And supply is retail. Okay. All right. So an important part to this whole process is understanding, what's more important. So I know trading in the market can be very exciting because with the volatility that there is now, price is moving up and down really fast, and people want to get in, right? It's crazy how much volatility happens early in the morning, but that part of the business, the trading side, should come second to your retirement, to your goals to have enough in your nest egg, right? Because like I said, everyone has to retire someday. I don't care if you're in your 20s, 30s, 40s, 50s, you have to have a plan for retirement. So I always like to start the conversation about that, okay? So let's talk a little bit about being in a mutual fund and a retirement account. There's different types of retirement accounts. You can be in a 401, 403 if you're in education. There's IRAs, there's Roth IRAs, self-directed IRAs, all of these different type of accounts. But what's common with all these accounts is they're oftentimes managed by a money manager, right? There's someone that's taking your money and they're investing it in the market and they're managing your positions, okay? Now they don't do that for free. So money managers are going to charge you a fee. Typically, it's about 1% to 2%, okay? That might not seem like a lot at face value, but once you compound that over 30 years, it's incredible how much money it adds up to because of the compounding effect, okay? And a lot of people are like, well, I'm doing great in the market right now, Hassan. I don't care paying 1% to 2% in fees, right? So your markets are going up and your account's growing, right? Your rate of return is earning you growth in your account. And then, you pay a little, like I said, you pay some of that. Usually it's about 2% to the money manager. But do the markets always go up? They don't. We learned around this time last year, before Corona, the market started to go sideways. Now, when the markets go sideways, your account stays the same. It's not growing in terms of value, right? But the money manager is still taking the fees, okay? And then what happened in February of this year, the markets corrected about 36%, okay? Now, albeit we had the fastest rally after that drop. It was the fastest 52-day rally in S&P history. So we have what we call a V-shaped recovery in the market, and now it's breaking through all-time highs. So S&P broke through all-time highs yesterday. The Dow did it last week. NASDAQ, all these indexes are hitting all-time highs, right? So the markets go down, your account value starts to go down, okay? It's called unrealized losses. You're in unrealized losses. But you're still paying the fee to the money manager. So now the tables have turned, right? Because your account has dwindled, you're in those unrealized losses, but they're still taking their fee. It's up, down, sideways. Money managers do that, okay? So what are you losing from the lack of education? To know what exactly to do when in different market conditions. Let's talk a little bit about compounding, because that, like I said, that 2 to 3% is over a period of time really affects the size of your account. So Jack Bogle, he actually founded the Vanguard Group, and so Vanguard's one of the largest investors in the world. I mean, they set up a lot of people with retirement accounts, and he's no longer with us. He passed away about 2 years ago, but he was huge on the magic of compounding, okay? So take, for example, let's say you have $10,000, right? And you take that $10,000 and you put it into an account. You don't touch it. You don't put more money into it, no contributions, and you don't take anything out, okay? At 10% rate of return, so I'm gonna throw some math at you out here right now. So $10,000, for 50 years you let it sit, and it earned 10% rate of return every year. What would that $10,000 look like after 50 years of compounding? It's over $1 million. It's 1.173 million, okay? But remember, we talked about the money managers taking out the 2%, right? Let's conservatively say we're at 2%, okay? So now, net, where are you at? What's 10 minus 2? 8%, right? So that 8% over 50 years looks a lot different than 10%. In fact, that 2% fee is going to cost you about $700,000, okay? It's because compounding works like an accelerator. Towards the latter years of the account, there's more money in there. So when you earn 10% of more money, that's more money, right? So you supply 100% of the capital, but you only get to keep about 469,000, right? Okay, it kind of looks like this on a chart. So for all my data people or chart readers, it looks like this, right? You'll notice that for the first 25 years, so look at the bottom, the first 25 years, the curve is relatively equal, right? After the 25-year mark, it then really picks up. Right around 35, you see the split. You start to see the growth, right? And what do you do about it? Well, at that type of difference, I mean, we're talking over $700,000 in difference. You can do a couple things. You can either increase the rate of return, right, to offset the fee. So if you did 12% instead of 10%, then the 2% offsets, right? You're back at net 10%, right? But what you can also do is decrease this. So let me take a few moments and talk about the different asset classes that people can trade in, that where you can put your money into, okay? Okay, people are like, what the heck are you talking about asset class? Well, most of you are probably already invested in some of these. We have mutual funds, right? We have ETFs, which are very similar to mutual funds. ETFs stand for exchange traded funds, okay? They are a basket of stocks, just like a mutual fund, okay? So a mutual fund has maybe 300-400 different stocks that are the underlying assets of that mutual fund. Mutual fund's like an umbrella, it's a basket, right? ETFs are the same thing. But you can be invest in different types of ETFs. This is where people start to diversify, right? You can be in equity in ETFs like S&P, NASDAQ, Dow, which is mostly stocks of like tech companies and the top 500 companies, right? Or you can be invested in energy ETFs. So that's a whole different type of market. It's a commodity market, right? It's things people actually need, right? There's precious metal ETFs like gold. There's an ETF for gold, okay? The biggest difference between ETFs and mutual funds is the maintenance fee, okay? So instead of 2%, which is typically your fee for a mutual fund, and some people tell me, well, I don't pay fees in my mutual fund. I'm in a no-load mutual fund. A no-load mutual fund just means you're not paying sales commission. You're still paying a fee. They're not going to manage your money for free. It's impossible, right? How are they going to survive, right? So an ETF, some ETFs charge 0.25%, 0.25% to manage, okay? So instead of 2%, now you're paying 0.25%. And let's say you increase this to 12 and decrease that to 0.25%. Now what's your net? 11.8. There it is. Reduce this to 1/4, increase that to 12. Now you're at 11.8% rate of return net. That curve is going to look a lot different, okay? There's retirement calculators on our website. You can play around with the numbers. You can compare investment fees, and it will tell you over 30 years, 40 years, what's the difference in your account size. It's staggering because of the compounding, okay? All right, let's talk about the fun stuff. Day trading, trading different assets. Oh, let me continue here too, before I get into that. So mutual funds, ETFs, they're baskets of stocks. Now people are like, well, I just want to invest in stocks. Can I do that? Yeah, so you can buy and sell stocks. Okay, you can day trade stocks. Not the best way to do it, but you can day trade stocks. Now most people, they live their whole lives up here. Okay, we call these non-leveraged assets. Okay, non-leveraged. That means if I put $1,000 into this non-leveraged account, my $1,000 equals $1,000. There's no leverage, right? It's like going to buy a home all in cash. You don't get the benefit of the banks, right? Now, some people trade with leverage, and people tell me, well, I heard about this Warren Buffett guy. He trades billions of dollars of options. Can I trade those? So now we have options. Okay. And some people are like, well, I want to trade the market after it closes and before it opens, okay, which is a global session. Can I do that? Yeah, you can trade that, and we call that the futures market. That's what I trade. Okay? Futures are like commodities. Corn, wheat, soy. You can trade gold future contracts. You can trade silver. You can trade platinum. You can trade all these precious metals. You can even trade the indices as a futures contract. Okay? So instead of trading the S&P 500 as a stock, which is called SPY, anyone heard of SPY? Spider? It's the S&P 500 as a stock. Okay? You can also trade the S&P 500 as a futures contract with leverage. Okay? How much leverage? Well, it depends on the market you're trading in. We'll talk about that. Forex is the largest market in the world. How much money do you guys think is traded on Forex? Just give me a number. Give me a wild number off the top of your head. Billions. Trillions. trillions. All right, billions, trillions, trillions. So $5 trillion is traded in the forex market. Not every month, not every week, every day. Every day, $5 trillion. In fact, if you took all of these markets and put them together, it still would not equal how much money is traded in the forex market. It's because it's a global market and it's the currency market, okay? Now, these assets are what we call leveraged assets, okay? So this is leveraged. Okay, how much leverage? Well, options give you 10 times. So your $1,000 equals 10,000 in the options market. Okay? Futures, 20 times. And Forex gives you the most leverage, 50 times. Excuse me, so your $1,000 equals $50,000 in the market. Okay? That's the most leverage. Now, leverage is a double-edged sword, folks. So I know it's exciting to make your money act like more money, but there's leverage is not any more riskier to trade with leverage. It's just because with leverage, your account size can go up or down very quickly. Okay? So whenever you trade with leverage, the biggest thing you have to learn is proper risk management. This is it, you folks. I mean, I've been doing this for a little bit of time, and if you can't manage your risk in the market, especially with leverage, you're going to get burned. What's going to happen is what we call you're going to blow up your account. Okay? So you need proper risk management, not just trading with leverage, even without leverage, because who wants to take on more risk than they can actually afford, right? So risk management is going to be the key. Once you take care of this, making money is going to be on the side. That's a result of taking care of this, okay? Proper risk management. We're going to talk a lot about that today and how Click addresses it.
Can you go back real quick and explain really quickly what options are?
Yeah, options. So when you trade options, you're trading stocks as the underlying asset.
Oh, gotcha, like
So if I wanted to buy Apple stock, it can get kind of pricey, right? Before the split, it was like $500. Now it's like, I don't know, 120, 130. But if I bought 100 shares of that, I need $12,000, $13,000, right? With leverage, I can control 100 shares for a fraction of the cost. So now I'm not owning it, I'm controlling it, okay? And options work in contrast as expiration dates. Not enough time for me to cover that, but good question. We will definitely get our fingernails underneath options and all these markets in that 3-day class that I'm going to talk about a little bit here, okay? It all starts with candlesticks. That's how we learn how to help people reach their goals, whether it's income, cash flow, retirement. It's all about reading a candlestick chart, okay? Starts with these little bars with lines on the top and bottom of them. All right, so a candlestick will open. So when the market rings at 6:30, right, the stock market, there's an open price, okay? Whatever happened overnight in the other side of the world can affect the increase or decrease of the value of that asset, okay? So the stock will open, and throughout the day for 6.5 hours, so 6:30 a.m. Pacific time to 1 p.m., the market's open, and price goes up, and it goes down, and it just continues to do that, okay? It creates a low. That means that's the farthest it got in lowest in price, and then it goes up, creates a high. And then at 1 o'clock, when the bell rings, it settles and closes at a price, okay? If price closes higher than where it opened, it's a green candlestick, okay? If the close is higher than where it opened. Now, price again will open, and it'll go up and down, up and down. It just does that all day long. And then it'll close. And if the close is lower than where it opened, it's a red candlestick. Okay? Green if it's higher, and red if the close is higher. Lower. Okay? This is known as the body from this point to that point. Body of the candle. And this here is the tail or shadow. Okay?
Is that per day, right?
Good question. There's multiple time frames. If I'm on a daily chart, so candlestick represents two things, time and price. Okay? If I'm on a daily candlestick chart, how much time is one candle? 1 day, right? If I'm on a 15-minute chart, how much time is one candle? 15 minutes, right? This doesn't mean that you're going to be in the trade for 5 minutes or 15 minutes, because I had some confusion last time. Because if that was the case, everyone's going to want to trade the 5-minute charts, right? Everyone want to make money fast, right? It just means that that's how long each candlestick is open and closed for. That's it, right? Just a time that it's open and closing for. If I'm on a monthly, that means that one candle represents 1 month of time. So price doesn't move or appear to move fast on a higher time frame. It appears to move fast when you get low, like 5 minute or 1 minute. Then you see that sucker go like this, up and down. And with the volatility, it's huge. They're big candles. Okay? We analyze charts, candlestick charts. Okay? So let me blow this up here. All right. So I'm going to try to work off one chart. So I know for you it might be a little difficult, but you might want to just watch over here. On the top left corner will always be the symbol of the chart. Okay. If you want to move, you can move over there if it helps. It's the same, but I'm pointing over here. I can't explain on two different screens. Yeah. I'm good, but I ain't that good. Okay, perfect. This is the symbol. That's the time frame. You guys see it daily? So on a daily chart, how much is one candlestick? 1 day. All right. This is the price, lowest on the bottom, highest on the top. Okay. This is the time axis or the timeline. When I'm reading a candlestick chart, I'm going to go right to left. All right, so current price is right there. All right, that's the current price right now of this chart. Okay. It's a little unorthodox because when we read English, where are we reading? We're going left to right, right? So people have a tendency to start over here. You got to start right there and work your way back. Everything here is historical data. Okay, this is price action between buyers and sellers. That's all a candlestick chart represents. Buying and selling, okay? Now, this drop right here went poop to the bottom, right? It took 1, 2, 3, 4 days for the price to lose probably a good percentage of its value, right? What do most retail traders and investors do? When price starts to rally, they get really excited, right? Let's say you're looking at a company, right? You've been wanting to buy this company or stocks. And you're just waiting like, I want to see, what's happening? What's the price going to tell me, right? And people will start, getting excited over here. And then they start to see it go sideways. And they're like, I don't know if I should get in, right? And then again, another boom, gap up and rally. And now they're really excited, right? And they'll buy it somewhere here, okay? And they'll hang on to it, 1, 2, 3, and they're like, oh man, I lost some money. It's okay, I'm gonna hang on, right? And then they see this huge rally, and now they're like, wow, I feel great. That's, this is gonna go up. I'm gonna hang on to this, right? And then it goes sideways, and then it drops, okay? And when this happens, I'm telling you, fear kicks in. You are scared. You're like, wow, what the heck just happened? And you're going to cry uncle at some point. You're going to say, I'm done. I lost too much. I'm out. And you get out right here. And what did price do? It went sideways and then rallied, right? So people are buying in supply and selling in demand. That's the retail mind. It's the way we're trained every day, right? So I don't want to buy it up here. I want to buy it down there and then sell it up here, okay? So if I can learn how to time this chart, then I can send an order to the market right down here. That's called a limit order, okay? Most people will buy with a market order. Okay, retail equals market. Okay. Institutional thinking equals limit order. Institutions don't buy at market. They're setting their price. Okay? So they will say, I'm going to buy 1 million shares down here. Okay? And when price comes back down, what do you think will happen when an institution gets in for 1 million shares at this price? Do you think price is going to go up or down? They're buying 1 million at that price right here.
I think will be going up.
Has nowhere else to go. If you look at the liquidity in the market, certain stocks, 1 million shares is a lot for one order, right? So price will then take off like this, okay? It doesn't happen all at once, but price will rally. Because the moment it rallies, you get the retail people jumping on, right? And then price keeps going up, okay? So I want to be able to do the same thing. I want to send an order to buy it here, but I need to pull back once it comes down. So look what happened here, and then when price came back down here. What did price do once it hit this area of demand? What did price do? It hit it and then rallied and took off, right? That's market timing. To send an order before it happens, okay, so that I get in the moment price turns around and goes back up, okay? So I'm going to throw a lot of ideas and concepts. Don't worry if you don't get it right now. It's okay. I'm going to bring this all together when I build out a trade for you guys, okay? So just follow along. All I need to know is I can send an order to my broker. Hey, broker, buy me at this price right here, 25,800. Okay. And it sits there until price comes back down. That's how you buy assets for sale, on sale, right? Don't buy it up at the market where it's there. Send an order to buy it somewhere down here, but you got to make sure that you're buying at an area of demand so price goes back up, right? That's the key. Market timing and proper risk management and sending certain orders, they all come together, okay? All right, so let me back out of this. We'll take a break in 5 minutes. Okay, there's a lot of indicators that your broker provides to you for free. Most of the time it's free. There's over 150 different ones. And those are these like squiggly lines up here. Basically they recommend to either buy or sell. The problem with indicators is that they're lagging. Okay? That means it needs data for it to tell you to do something. But by the time it knows what to do, it's going to recommend to buy somewhere up here because I need that data down here to recommend the trends going up. So now's a good time to get in. Okay? So they're lagging. I can't rely on lagging data. I need to be able to know where price turns before it happens, not after it happens, right? So we don't use a lot of indicators. We use technical analysis, but we don't use a lot of, in fact, I only use one just to know where price is at relative to the curve. But other than that, I'm using candlesticks to really understand where to buy and where to sell. So that's retail thinking. Too much noise, a lot of stuff doesn't really help. So how do institutions think? Much simpler, okay? Excuse me. Institutions, Wall Street behaves a lot like Walmart, okay? They buy it at low and they sell it high. Pretty simple concept, right? When an institution jumps in and buys a big order, has a big order, like I said, price has nowhere else to go but up. Now, when price comes back down, they're going to want to buy more here, okay? I'll tell you why. Because institutions buy at such large volumes that oftentimes there's not enough inventory to sell to them. So they will buy a fraction of that order, okay? So even like 500,000 shares would still make price move significantly. But what do? They wait, because they still want to buy 1 million, right? They filled 500, they got that part of their order filled, right? But they still want to buy it another 500 at this price level. Let's say this line right here, that line right there is $5 a share. Okay, you guys following along? It's $5 a share right here. They bought 500,000. They want to buy 500,000 more at $5, not a penny more. Right? That's what they decided. They did their analysis, and their people are like from Harvard, Yale, MIT, and they've done all their research, and they came down to buy it at $5 a share. Okay? Once price comes back down, the second part of that order gets filled. That's called an unfilled order. Okay? Unfilled orders is what we're looking for on a chart. Okay? Candlesticks represent filled orders. Someone already bought and sold there. But what's sitting behind the scenes, you can't see this. No one can really see all the unfilled orders. But what we're doing is we're training you how to find the behavior on a chart to suggest there are unfilled orders here. Okay? It's now you're putting odds in your favor, right? You're stacking odds. Strength is a big part of that behavior. So the way price leaves a zone is important. We call it strength. Okay? So the moment that price comes down here, I want to have an order sitting there as well for $5 a share. So I did my analysis, looked at it, and I determined that's a good demand zone. So I'm going to send an order to my broker to buy it at $5. Okay? Now here's the good thing. My order gets filled like that because I'm not buying at huge volumes, right? So it's almost instantaneous that your order gets filled at a certain price level. The idea is I want price to go up once it comes back down to $5, okay? That's market timing. I saw it happen once, so I want it to happen again, right? And the likelihood of it happening again is greater because this is a behavior of an institution, all right? Now, what if I'm wrong? We got to account for being wrong, right? We're not going to be right all the time. What if I'm wrong and there is no unfilled orders sitting there at 5? When price comes down, it's just going to blow right through that because there's nothing sitting there for it to go back up, right? Institutions didn't want to buy more. So in the event that I'm wrong, then I want to protect myself. And I'm going to do that by putting a stop. Okay? So now I have a limit to buy, and I have a limit for a stop. We call them a stop limit or stop market order. Okay? And I decided that the stop is going to be at $4 a share. Okay? So I bought it for 5 and I sold it for 4. How much money did I lose? $1 for 1 share. What if I bought 50 shares? $50. That's my risk. All right? That's my risk in the trade. At no point can I lose more than $50 because I have a stop sitting there to protect me. And I'm okay with that because I'm okay with losing $50 on that trade, right? Now, if you're going to risk 50, what do you want back? You're not just going to risk $50 just for, I'm going to risk $50. What, you got to be calculated. What do you want back? Do you want 1 time your risk? Do you want 2 times? 3 times? Right? If you're aggressive, you might have a 3 time, 3 to 1. We call it 3 to 1, right? If you're more conservative, it might be 1 to 1 or 2 to 1, right? You decide that. You decide it. Now, you don't just put it anywhere willy-nilly. You got to know where the price is going to turn back around, right? Because before that price comes, once price comes down here and you're live, you're expecting price to do what? Go up, right? When price goes up, if you hit this level, you're out 1 to 1. If you hit this level, you're out 2 to 1. If you hit this level, you're out 3 to 1. But what if price goes like this? And your target is there, right? Now you just lost the profit that you made. Okay? What is this? That's supply. So I'm going to have a target below supply. Because if there's unfilled buy orders, can there be unfilled sell orders? Yeah. Institutions will decide where to sell to. Okay? And I don't want to put a target up here and be too greedy, right? Because price will not likely even reach there. It'll turn back around in supply and go back down. So let's play it out. Price comes back down. Boom, right there you're in. You're live in the trade. The price is going to do one of 2 things. It might go sideways for a little while, but it's going to go up or down. With today's volatility, it goes up or down. Okay? If it goes down, what happens? Once it reaches there, if price just continues to go down, what happens? I hit my stop and I'm out for a loss, which I have to be okay with, right? But what if I'm right and there is demand sitting right there? Then price is going to do this. It's going to go back up, okay? And it's going to keep going up until it hits supply, turns around and comes back down. I'm going to re-emphasize this thing a couple of times today, okay?
At what moment, the limits will be moving?
The origin of every move in any market, I don't care what market you're looking at, the origin of any move going up and down is when price is out of balance. Okay? What happened here for a little while? It went sideways, right? Just for a little while, right? That tells me that there's the same amount of buyers and sellers, not a lot of movement. And then what happened? It took off, right? That's imbalance. Now I have more what? Buyers. So the origin of any move is this imbalance right here. Same thing for supply. What did happen here? It dropped, hit demand, went up, hit supply, went down. That's why the markets go up and down, folks. I'll show it on a chart, right? Any chart you pull up, it does this. Okay, that's just hitting off unfilled orders all day long. All right, so that's a concept of the way institutions think. Because where their risk and the reward is greater, now you have a formula, right? If I took 4 trades and I lost 2, what's my percentage? 50%, right? Is that good or bad? Normally, is it good or bad? Maybe with the market, it might not be. Not. Normally, 50. I mean, if you got a 50% out of on your test, you failed, right? But as long as the 2 winners are bigger than the losers, now I have a strategy to be more consistent over a period of time, right? If I lost twice at $50, how much did I lose? 100, right? If I won 3 times that 150, twice, how much did I win? 300, right? So even though I win 50%, I'm up $200, right? Net. So that's a formula, right? And then click rolls in risk. This is an important number. So I want you to focus here. I'm going to show it to you guys on click. Risk, managing your risk is really where you start your journey for anyone. All right, let's talk about, actually let's take a break, 5 minutes. It is 11:05. Wesley can help with the bathrooms. Please keep 6 feet apart. You guys are welcome to chit chat. I'll be at my desk. So you guys got any plans for the weekend? Or am I it? There you go. You're learning something, right?
It's all clicking for me now.
I could see it.
I've been working on this to understand all this for the last 2.5 weeks, and I finally found somebody on YouTube like 2 nights ago that it kind of started clicking, especially the candlestick charts. That was pretty tough, but the whole point of it was for those 2 weeks is to understand the lingo. So now I understand what you're talking about. Like forex, I'd be like, what the hell is forex? Foreign exchange. So I just wanted to get the concept of understanding the lingo so I can follow along.
Yeah.
But it's all clicking even more. So I'm like, finally, I get it.
Yeah, it's when light bulbs go off, it's an amazing thing. You know, the other thing that's going to be really important once you understand the markets is how they can become vehicles for what you're trying to do. Because that's ultimately what it comes down to, right? If I'm going to trade the forex market, I need to know why, right? If I'm going to trade stocks, I need to know why. Each market is a vehicle. So when people tell me I day trade stocks, I cringe a little, right? Because why would you do that? Well, because that's what people do. Oh, okay, so you follow what people do, right? Jim threw himself off the cliff, you're going to throw yourself off but that's the world we're living in, folks. We're living in a highly automated world, right? Only the people that can use their minds to affect change in themselves is going to get through this, right? Because a lot of people are hurting right now. I mean, look at it like this. 30 million people lost their jobs during COVID, okay? Roughly 20 million small businesses closed down, okay? People are struggling to pay their rent and mortgage, but the market is at all-time highs. Why is that? Because the stock market, Wall Street, is totally disconnected from Main Street, the economy. Economy and the market are not correlated. People think that. They're programmed to, right? You know? The banks failed in 2008 because of high-risk loans. That's it. It wasn't no conspiracy or this and that. Banks couldn't support it. People couldn't pay it. And the debt's gone. And then now you have all this debt. And it's like the market corrected 57%. You know? Yes. Yep. Yep. So there you go. So what you just said, Warren Buffett capsulized that in this quote. He said, when people are greedy, be fearful. People are fearful, be greedy, right? Because if people are buying it all day long, they're hopping on the train too late. So price keeps going up and up and up and up and up and up. It's too expensive. Stocks are very, they're overvalued right now. Very overvalued. That's not a good thing, okay? Because I want to be the person that sells to them at the top of the market. I want to sell at the top and buy when it comes back down. So that's important, really important. All right, let's continue. Let me grab some water here, get a little bit of, I talk a lot, so get caught now. All right, we're going to start up, folks. So there's two types of positions that you can be in when you're trading in the market. You can be in a long position. Long just simply means that I buy to open my position, my trade. And when I buy, first, I'm always expecting price to go up, okay? So I buy to open, and I sell to close at a higher price. That's how I turn a profit. Simple economics, right? Buy to open, sell to close, I make $100. Now where I lose people, and it took me a while to get to know, to understand how to short in the markets. Shorting is just another strategy when the markets are going down, okay? I don't ever want to short when the markets are going up. Momentum trading, a lot of people talk about that. But when trend's going up, I want to find a little bit price lower to buy so I can keep going with the trend. But shorting happens when I'm in supply, okay? And I sell to open my position. So that's my first act, is selling. And I'm going to buy it back when the price is lower, okay? And that's going to buy to close my position. Now here's where I lose people. They tell me, how the heck can you sell something you don't own, right? You can. Your broker will allow you to short. The only asset you can't short are mutual funds. You cannot be in if you're in a mutual fund and the market goes down, you can't take advantage of that. You're going to lose value, and you got to either sell it or wait till it comes back up, right? Everything else I can short. If I open a broker account, they'll let me short stocks, ETFs, options, futures, forex. Now options can trade in even a sideways market. There's strategies for a sideways market for options, okay? That's why they call them options, because they give you options, right? So buying first means I'm going up. Selling first means I want price to go down, okay? We're gonna break this apart in our 3-day class. So wherever I buy it back at a lower price, that's my profit, okay? If I sold it for 200 and bought it back for 100, then I make $100, okay? Now, I want to talk a little bit about the opportunities that we had historically to short in the market. When were there some good times to short? Markets don't always go up, they come down. Here's a chart of the S&P 500, okay? Over here was 2000, the dot-com bust. I don't know what age group you guys fall in, but I remember that. 50 some odd % of the value of your assets dropped, and it took 3 years. Okay, so this doesn't happen fast. It took 3 years for the markets to lose 50% of its value. Okay, and over here, so that was 2000. Over here, 2008, that was the mortgage crisis. I knew a lot of people that were hurt by that. Okay, they lost their homes, their investments, all that. Okay, 57% the market corrected, and it started in 2008 and it ended right around mid-2009. So about 1.5 years now that the market corrected, went down 57%. And then we had the longest bull market in history. Okay, 10-year run for the S&P. And then coronavirus hit right there at the top. And it's about 36% of the value of your assets lost there. So let me ask you guys this. You think institutions are just twiddling their thumbs for 3 years when the markets are going down, or are they shorting? They're shorting, right? 2000, 2008, 2020, a lot of people made a lot of money, okay? Because they know how to short in the market. They know the conditions. They know how to place the action, right? We talk a lot about this, but most people don't even know how to fund a broker account and send an order to the market, right? So you got to get that fundamental down first. Then you got to learn how to read charts. Then you got to practice it, right? Then you start trading live. Again, a lot of people come in here that have been trading live in the last 6 months using Robinhood, right? Like, why would you just start live trading out of nowhere? Like, what compelled you to start putting money in an account and trade? It's mind-boggling. We practice here for a good while. We sim trade, paper money, monopoly money, right? Until we get comfortable and confident. Because the difference between live and paper money is the money. You can still trade sim live in the market with real market conditions. You can still send the same orders to the market using sim money. And then once you build confidence and you're comfortable and you see results, right? I tell my students, you better keep track of your trades. Because if you want help from me, I need to see 30, 40 trades from you. Then we can sit down and analyze it. Are you profitable? You're not profitable? What's going on? And then when you're ready, then you put money into an account. You got to know what broker, which account, what type of account, margin, not margin, right? There's a lot of intricacies with trading that people just don't really get because companies like Robinhood make it too easy. They invented fractional shares. That's how you can buy Amazon for $100 in your account, right? Futures have been doing fractional contracts for a long time, more than 20 years. I can own a fraction of a contract for a low price and risk less because they've been doing that for a long time. But Robinhood makes it too easy. All right, so that is short selling opportunities. You have to know when the market turns so that you can be in the right position, right? How about the pros, the institutions? We see these articles every day. Goldman Sachs makes millions of dollars, Morgan Stanley tops estimates, right? So what I did was I pulled data from the website, Goldman Sachs website, and I put it on a chart, okay? So when I look at this is a bar chart. When I look at this, 3 things stand out to me, okay? First one, do institutions lose? Looking at the charts. Look at the charts and tell me, did Goldman Sachs lose at all? The answer is right there. Institutions lose. The answer is yes. Institutions lose, right? The second thing that stands out is, do institutions win more than they lose? Answer is yes, right? 221 profitable days versus 31. And the third thing is, are their profits bigger than their losses? Look at the chart, right? Looking at the chart, are the profits bigger than the losses? Yes, they are. So now there's a formula going on here. They win more, their profits are bigger, right? But they do lose. So you have to be okay with losing. Because some people aren't okay with it, right? I've had people come here, I try to teach them this, they'll hit me up later and be like, I lost my account. Well, did you put a stop in there? No, I didn't want to stop out. I thought it was going to turn back around and go up. Why would you think that? You bought it at the top, you didn't put a stop, and now your account's gone, right? You got to be okay, because they're not okay with losses. They think if they stay in it long enough, it'll eventually turn around. Yeah, certain assets over a long period of time will ultimately your net's profitable. But are you going to wait 15, 20 years for your trade to develop, right? If you're a day trader, you don't have that time. You're in and out in that same day, right? That's 1 year. I pulled the last 10 years. It's like the chart doesn't change, right? I mean, they're profitable year over year over year. Okay? And some people are like, well, Hassan, you said that the last 10 years was the longest bull market. It wasn't hard for people to make. When markets are going up, it's not hard for people to make money, right? Because you just buy it and it goes up, right? So I went to 2008 when people like us were losing our shirts in the mortgage crisis. How was Goldman Sachs doing in 2008? They were still profitable. Okay, yeah, albeit they had more losing days than normal, they still were profitable because they know how to short, right? So that's important, you guys. All right, let's talk about core strategy. So in core strategy, we bring in market timing, risk management. Okay, we bring that all, right? Because when you do that, you're putting the odds in your favor. We're never going to be right 100% of the time. If you think like that, trading isn't for you. Okay? And it isn't for everyone. I mean, that's just the reality of it. Supply and demand is involved with market timing. Okay, so let's kind of go back a little bit. I want to talk about how this all started because it'll start to make a little bit more sense. And I don't expect you guys to know exactly what I'm doing here in 2 hours. That's not realistic, but I want to do my best to help you guys capture the big picture. So supply and demand started when one of our instructors used to be he was an analyst for institutional order flow. He worked on the CME. So for those that don't know the CME, it's one of the largest financial hubs in the world. When people talk about New York Stock Exchange, Tokyo, London, CME is up there with those exchanges. CME stands for the Chicago Mercantile Exchange. Okay, it's in Chicago. If you ever saw that movie called Trading Places with Eddie Murphy and Dan Aykroyd, that was the CME, the pit. They call it the pit. That was this. They're all in there in the middle, buy, sell, with their hands. Back in the 70s and 80s, trading was not computerized. For you to be able to trade, you had to call your broker on the phone, right? So you pick up your phone, the one with the rotating dial, and you call your broker and you say, hey, buy me 5 contracts of corn, okay? And your broker would write it down on an order slip, okay? And out in the lobby, there's a picture of the pit with all these papers on the ground. So all these little orders on the ground. They would write the order on that, and they would literally stack it on a table like this. On one side, you have sell orders, and on the other side, you had buy orders, okay? And the higher the price, the bigger the orders stack was. Literally, it was stacking up. On the lower the price, the bigger the stacks, okay? And then in between, it started to get smaller. It kind of looks something like this. Okay, buy on one side, sell on the other. The higher the price. So let's say current price is $50. The higher the price, the bigger the stack, and it starts to go down, taper down when you start to get towards current price. What these stacks are unfilled orders. They're pending orders. They're waiting for price to come down or go up, right? So if you kind of, because now trading's computerized, so if you kind of took this, the concept's still the same. If you took this table and you flipped it around and you put it on like next to a chart, it looks something like this. Okay? So down here in demand, what are we doing in demand? We're buying, right? Get that into your mind. Demand, buy. Where am I buying? Wholesale, right? I'm buying at wholesale in a demand zone. Whenever there's a large stack of orders like this, I have too many buyers than sellers, so price has nowhere else to go but up. So notice how as it goes up, it eats away at the orders. They start to become filled. They start to become real orders, right? And then it'll keep doing that until it hits a stack of sell orders. And when it hits this stack, it cannot go anywhere else but down because it hit a wall of sell orders. That's all that people are doing up here at $54 selling. So it'll come back down and it eats away until it hits demand. And what's waiting there in demand? For when the price comes down, what's waiting there? What are these? Which type of orders? Buy orders, right? It's waiting there, and alongside there is my order, sitting there at $46. So I want you to think of it like this. This is what my what my mentor told me. Like, if you really want to get people to understand this, I want you guys to imagine an elephant. It's a big animal, right? One of the largest land mammals in the earth. And a swimming pool, okay? What happens to that water level when the elephant jumps in the pool? It goes up, right? It rises, right? What happens when the elephant gets out of the pool? Comes back down. Same thing in the market. The institutions are the elephants. Now, what happens if an ant jumps in that pool? What happens to the water level? Nothing, right? Same. What happens when it gets out? Same, right? So I want to be that ant on the back of that elephant when it jumps in and when it gets out, okay? That's simply what I'm trying to do. I'm trying to time that elephant so I can be on the back waiting. Whenever it jumps in, price goes up. When it jumps out, price goes back down. I want to sell it up here and buy it down here. What do I put on the bottom over here if in the event I'm wrong? What do we call that? What do I put below this line? If I'm buying here, stop. Good work. I heard it from you first. So in the event I'm wrong, because I could be wrong, right? I did all my research, all my analysis, built out my trade, and I was wrong. It happens. It happens a lot. I'm stopped out, and I take the small loss. I'm okay with that, because the probability of this going back up is high down here. So the moment it hits, price goes back up. What are we going to put above this? So if I have a stop on the bottom, what am I going to have above that? A target. So here's one of the most important acronyms of the day. SET. Stop, entry, target. Okay? Stop is down here, below the price. Entry is on this black line right here. And then my target's going to be somewhere up here depending on how aggressive or conservative I want to be. Right? So we got stop, entry, target. We call that a bracket order. Most brokers will allow you to send a bracket order. What a bracket order is I'm telling my broker exactly what to do at what price. Okay? And it sits there. And it sits there until price comes down into the price level at $46. And if it goes up and it goes my way, I have a target sitting right there, 3-1, I'm out, right? Now, because I know to a certain degree that price will turn up here, like it did the first time, I might have my target somewhere up here and just maximize on the whole thing, right? So that would be like a 10-1, right? Which now we're putting odds in our favor, right? Because I could lose a bunch of trades if I went on 10-1 on one trade, right? All right, let me cover the 3-day class, and then I'm going to hop on Click, and I'm going to demonstrate. I'm going to bring all this together. So everything that I talked about today, I'm going to show you on a chart. But before I do that, let me just quickly talk about the 3-day class. So the 3-day class is designed really to help you get your fingernails underneath what I'm talking about today. My goal today was to get you excited, to get you energized, and to show you high level what we do, right? If this is something that you enjoyed, yet you want to continue to do, then the next step is the 3-day class, okay? So let me cover that. It's jam-packed. We go 3 days, 8 hours a day. So that's 24 hours, okay? Day 1, we're going to cover leverage I touched on that today. I touched on market timing. We're going to go real deep into futures. Short selling, I kind of touched on. Core, I definitely talked about. Okay. Talked about options. Talked about forex. Stocks. Can you put on vibrate, please? Stocks. Risk management. Okay. So still a lot of things that, and just unfortunately a time constraint, I wasn't able to really get into, but that's a 3-day class that's coming up. So Click, which I'm going to show you guys, an awesome tool for trading and investing. We're gonna roll that into the class as well. Okay. All right. So these are the dates I have coming up. December 18th, 19th, and 20th. All of our 3-day classes is Friday, Saturday, Sunday. We try to make it over the weekend so that most people are off on the weekend. I know some aren't, but those are the next class that's coming up, December 18th, 19th, 20th, right before Christmas. Okay, so check your calendar if this is something that you can attend, then write it down. If you can't make these dates, that's okay. Usually we have 1 to 2 per month. So January would be the next one. I don't have those dates yet, but what you can do is just put TBD, like for the online one. And then once we have it added to the calendar, then we call you and then say, this is the dates, can you attend these ones? Okay? But this is the one that's coming up in 2 weeks from yesterday. So, all right. We do have it online. Online is a little bit shorter because we don't take so many breaks. There's not so much questions. When in center, you get a lot of questions. You get a lot of people, different goals. So we typically take breaks. We talk about those. So we go about 8 hours in center and about 3 hours with like 1 or 2 breaks for the online one. Okay? So totally up to you. If you feel comfortable coming here, spending 3 days with us, great. If you want to do it online, that works as well. All right, so there is a tuition involved. Typically we charge $199, but we are kind of, tough times for a lot of people. There's definitely a lot of value here. I mean, you get to bring your spouse or significant other. If they're not here today, that's okay. They're welcome to join you. We have those classes here in this room. And usually we have no more than about 8 people because of COVID. So you guys are always like spaced out like this.